Okay. Two things. One is I want to remind you that there's no class next Monday, right? So it's President's Day. I don't know why we get a day off for President's Day. I've never figured it out. No, it seems like a big shopping day. Other than that, I can't think of anything else. But it's a good time to get caught up. On what? I know how much some of you are falling behind already. You picked a company and said, I'm done. You're not really done. You've just begun, right? So I think this might be a good time to start catching up. So I'll give you some ammunition today that you can use if you want to get caught up on it. If you get a chance, also visit that weekly challenge that I put out yesterday, because it cuts the core of how we think about investing. Do you see the weekly challenge? Or are you already blocking my emails? Okay. This is really, it goes to that core assumption we make in finance that diversification is a good thing, right? So if you open up finance textbooks, you listen to people like Jack Bogle, their advice is diversification is good. And you think by the time you finish these books and listen that this must be consensus, right? Everybody, but it's not true. There's actually a fairly large subset of people, some of whom have very good reputations, who argue that diversification is a bad thing. That concentration is a better thing. That if you want to make money, you can't make it by buying 500 stocks, you should buy 5 or 7. And if it were easy to dispense with the second group and say they were wrong, I would do it, but it's not that easy, which is part of the reason I wrote that blog post about how much should you diversify. And if you think I'm going to tell you to diversify to the market portfolio, you're mistaken. So I'm not going to tell you what I did write in the post because I'd like you to read it, because I argue that it's really a trade-off, and you have to decide for yourself whether that trade-off will lead you to put all your money in one stock, and what has to be true if you do that, or if the trade-off is going to lead you to buy a Vanguard 500 index fund or some diversified portfolio. But it's a choice you have to make. I can't impose my choice on you because, as I said, my choice has been to be somewhere in the middle, 53 stocks. I'm not Jack Bogle-like. I'm not Mark Cuban-like, because I think one of the voices in favor of concentration is Mark Cuban. I'm falling somewhere in the middle, and that reflects my trade-off. So I'm going to start today with a question I promised you I would ask, because this question is, I think, one of the most critical questions in finance. If you can get it nailed down, so I've kind of set it up now, so if you can give me the answer, you've already solved one of the big questions in finance, so go for it. You've cracked what I call the currency code. Last session, if you remember, I talked about estimating risk-free rates in different currencies, right? In some currencies like the US dollar, the euro, the Swiss franc, I was able to just take the government bond rate and use it as my risk-free rate. But in other currencies, I had some work to do. I started with the government bond rate, and then I netted out from that the default spread in that government using the local currency rating or a sovereign CDS. So what you see here is actually my estimates of the risk-free rate. So if you take the Nigerian naira, the government bond rate is in excess of 15%. It's about 16%. But the default spread in the bond is about 5%. So by the time I net it out, I end up with a risk-free rate in naira of about 11%. And I do that with every currency. So when I'm done, I have risk-free rates in about 30 different currencies. And the rates are all different. The risk-free rates in some currencies are really low. In fact, some of them, they're negative. We'll come back and talk about what to do with that mind-boggling concept. And some of them, they're 10% plus. So you ready for the question? Here's my question. Why do risk-free rates vary across currencies? Yes?
Sovereign risk.
I call my rate risk-free rate, right? So I've already cleaned up for sovereign risk. So unless you tell me that I haven't cleaned up enough, remember that's why I took out the default spread. If I'd shown you government bond rates, that would be the easy answer. Of course, sovereign risk, that's why the Indonesian, but I've presumably taken out the sovereign risk, so if these are risk-free, what's the other reason?
So these rates are nominal rates?
They're always. Whenever you talk about currency, it is nominal, right? Inflation is the only reason for differences in risk-free rates. And therein lies the solution to the currency problem. And here's why it's a solution. If I pick a high inflation currency like the Nigerian naira, what kind of cost of capital or hurdle rate am I going to get for companies? Don't think through too long. So I have a high risk-free rate. My hurdle rate is going to be high, right? You're saying that's awful. That's not good. But when you do your cash flows in your accounting earnings, you should be doing them also in Nigerian naira. And that same inflation rate that pushes up your discount rate is also going to push up your cash flows. I'm going to say something up front, which I can't prove right now, but later in the class I'll come back and back it up. If you're asked to do a valuation or a capital budgeting exercise and you do it right, it should be currency invariant. Know what I mean by currency invariant? You project out the cash flows in Nigerian naira, you discount them at a Nigerian naira discount rate, and you come up with the value for the project. And then you take the same project and do everything in US dollars. If you've done it right, you should get exactly the same value for the project either way. And that's a good thing. Because think of the alternative. If, in fact, you got different answers depending on what currency you did the analysis and how exactly would you phrase the conclusions you came up with on this project. In dollar terms, it looks like a good project. In euro terms, it shouldn't be that way. A good project should be a good project no matter what currency. But to do that right, you need to remember that the reason for big differences in risk-free rates is inflation. The inflation rate in Nigerian naira is close to 10%. No surprise, its risk-free rate is high. And we've already now come up with an answer to how can risk-free rates become negative, because this befuddles people, because it goes against everything you're taught in Econ 101, right? You lend money to people, they're supposed to pay you, not the other way around. But you have Danish homeowners who are now borrowing money to buy houses, and the bank sends them a check. It's not the way the world is supposed to be. So for people, negative risk-free rates seem unnatural. But I've kind of given you a way of explaining negative risk-free rates, right? So what has to be true about inflation in a currency for risk-free rates to become negative? They could be deflation in the currency, and on top of that, if you have real growth, be a zero or a negative number. A deflation plus negative real growth yields a negative risk-free rate. And before you start celebrating that this is good, this is not good. Because if you have a negative risk-free rate, it's true your cost of capital and hurdle rates will be lower. But when you do your cash flows, you're going to be fighting against, you're climbing a mountain, because with deflation, even if you sell the same number of units you did last year, your revenues will go down. So this is kind of a mixed blessing when you see very low rates, because very low rates are good news for your discount rates, but they're bad news when you start projecting out growth and inflation and cash flows, because what helps you in one place will hurt you in the other. So when you think about currencies, think about inflation. You'll be amazed again how often people choose between rates without even controlling for currencies. They'd say borrowing at 3% is cheaper than borrowing at 8%. You think, of course it is. But what if I'm borrowing at 3% in US dollars versus 8% in Indian rupees? That's a much tougher choice. You cannot compare across currencies until you factor differences in inflation. Any questions? So let me close with one final question. Risk-free rate in the US T-bond rate right now in US dollars is about 2.5%. 10 years ago, that rate was 4.5%. 25 years ago, that rate was 6.5%. In the late 70s, that rate was 9%. So T-bond rates have clearly come down. This is not even debatable. We're in an era of low risk-free rates in US dollars. Why have risk-free rates been low for the last 10 years? Nobody wants to say it's Janet Yellen, because that's what I hear. When I turn on CNBC, you know what I hear? It's the central banks that... I'm going to tell you a story to bring home how little power central banks have. And this is my personal story. You know, you can go to the Federal Reserve and they'll take you on a tour of the Federal Reserve. It's actually a neat tour. If you've never been there, the Federal Reserve building is like a prison building. It's right opposite that Maiden Lane building with Chase building. So you walk across, there are like big bars on the windows and stuff. You walk into that central floor at about 9:45 every morning. They take you on a guided tour of the Federal Reserve. So about 2 years ago, we had nothing to do one day, so my wife and I and two of our kids who didn't want to go, but we promised them like frozen yogurt or something afterwards, or cronuts afterwards, and they said, okay, with the cronuts maybe we'll come. So we decided to go to the Federal Reserve. We walk in. I almost made myself persona non grata 2 minutes into the tour. Because this young 23-year-old nice person comes up, she's the tour guide, and I almost made myself persona non grata by asking her a question. The question I was going to ask her was, where's the interest rate room? You know the room I'm talking about? Where Janet Yellen comes in every day and there are these big levers around. There's the T-bond rate that she moves around, the mortgage rate that she... I mean, that's the image you get when you listen to CNBC or read the New York Times. It's that central banks, if they want to keep rates low, can keep rates low. You know how absurdly stupid that concept is? Because if that were true, why did T-bond rates get to 10% in the late 70s? Because if they have that much control over rates, they would never let rates rise, right? The central banker is like the Wizard of Oz. You ever seen the movie? One of my favorite movies of all time. Of course, the movie starts with Dorothy leaving Kansas. Well, not voluntarily, but I think a typhoon, a hurricane, whatever. I don't write the script. It dumps her in Oz. She lands on top of the witch from the east or witch from the west, or no, which one, kills the witch. She's facing homicide charges. And she wants to get back to Kansas. I don't know why, I'd have stayed in Oz. And of course, that's how the movie starts. She lands on the witch dies, and she asks this munchkin on the side, I don't even know what those little people on the side, how do I get back to Kansas? They said, what's Kansas? We have no idea. You have to go see the Wizard of Oz. And the movie begins. Of course, she asks, how do I get to the wizard? So, Yellow Brick Road. You know the routine. For 3 hours, she dances, she hops, she never walks. Go watch the movie. She never walks during the entire movie. She skips and she hops, and along the way she collects a motley crew. A scarecrow, a lion, everybody needing something, and everybody thinking that the Wizard of Oz has the answer. 2 hours and 43 minutes later, they arrive at the wizard's chamber. So Dorothy steps up and she says, I'd like to go. So each of them states what they'd like. And the wizard, this deep voice, that's all you see, you don't even see the wizard, says, come back tomorrow. It's like a government office. And they said, we've been coming 2 hours and 43 minutes of movie time to get here. You want us to come back tomorrow? And at that stage that the curtain falls and they discover that there's no wizard. There's a little guy in the back pulling things. But what they discover is during the journey, they got everything they wanted, right? The lion fought off some bad guys, got courage. So each of them, and the same thing applies. We think that central banks set rates. They don't. They tweak rates at the margin. They like to act like they have the power to set rates. Why? Because that's how you respect them. We set rates. Listen to me. The reality is, central bankers are more onlookers than setters of rates, because if you have low inflation and low growth, which is what we've had in the US for the last 10 years, how can rates be anything but low? And if you have high inflation and high growth, how can rates be anything but high? In fact, I have a post on this, I'll send you if you want, that the effect of central banks is about 25 basis points. That's all they can change rates by, about 0.25%, now at the margin. But the bulk of the effect comes from the underlying fundamentals. So I think it's so easy to assume that there's this big power out there setting rates and we're all at the mercy of the big power. It's not. It comes from the underlying fundamentals, the same fundamentals that should be driving your earnings, your cash flows, and the rest of your analysis. Any questions on rates? Go ahead.
Will the market supply and demand also affect the rate, the risk rate?
That's absolutely right. When you buy bonds, why are you buying bonds? Because you want to get a rate of return, right? Let's say you expect inflation to be 6%. Would you accept a 2.5% rate? No. That's where supply and demand comes in, because when you think about supply and demand, they don't come out of nowhere. They come from your expectations of what inflation is going to be. So if I expect inflation to be high, I'm not lending you money at a rate lower than that, even if you're the US government. And if I expect inflation to be low, I'm willing to settle for a lower rate. You're saying, how does growth apply? If I have lots of real growth, the demand for funds will be higher than supply, so the real rate has to go up. So ultimately, if you think about demand and supply in the bond market, it's coming from perceptions of inflation. And the perceptions could be completely wrong, and perceptions about real growth in the economy. So it's true, demand and supply always sets prices. That's how markets work. But demand and supply itself are derived factors coming from what people think about inflation and real growth. And that's where central banks can have a difference, right? Because they can alter the perceptions. That's why Janet Yellen today, I think she's still testifying in front of Congress, says, we think inflation, we see signs that inflation is going up. That could affect your perceptions about expected inflation. That could push rates up. That's how banks work is. And for that to work, they have to be viewed as credible. And central bankers lose credibility. Then they basically lose all power, which is what's happened in Japan. The Japanese central bank, nobody really cares what the central banker says. For 25 years, they've stopped caring because they seem to have no credibility left. So when you think about risk-free rates, that's a factor I want you to keep in mind. So at this stage, are there any questions about risk-free rates? So depending on the currency you decide to do the analysis in, you need a risk-free rate in that currency. Let's move on to the next input I want to talk about, which is the equity risk premium. This is the price for risk. Let me set the table. What I'm trying to estimate with the equity risk premium is how much more than the risk-free rate I would need to offer you for you to buy stocks. So let's make this very specific. Right now, the risk-free rate in US dollars is 2.5%. The question I'm asking you with the equity risk premium is how much more than 2.5% would I need to offer you for you to buy US stocks instead of that risk-free investment? So think about it for a second, because already you can see what's going to drive this answer. First, it's going to be driven by how risk-averse you are, not the rest of the world. Just think about yourself. The more risk-averse you are, the larger the premium you're going to demand, because I'm asking you to take risk and you want compensation. The second thing that's going to drive the premium is how much risk you see in US equities. And that's again a perception. What's an average risk stock? Is it Microsoft or is it GE? That's going to drive what kind of premium we're going to demand. It depends on your risk aversion. It depends. So when we think about risk premiums, that's going to be the starting point, and let's lay the foundations then for thinking about risk premiums. Talked about risk aversion. So let's do a simple test of how risk averse you are, because risk aversion is not something that there's a right answer to. It's a personal number. So I'm going to see how risk averse this particular class is, and then I'll give you some perspective. I can compare you to every class I've done this on going back 31 years. So let's assume each of you has savings. That's an assumption. Don't fight it too much. Right? And that all your savings are invested in something risk-free, making 3% guaranteed right now. So you sit down for dinner, and you get a cold call. I've quit my job, and I've become a salesperson for the Vanguard 500 index fund. So I call and say, look, I hear you got all your money in something risk-free. You say, how do you know? I have my sources. This is how I keep you on the phone. So would you be interested in taking your money out of where it is right now, making 3% guaranteed, and putting it into the Vanguard 500 index fund? So I'm being pretty explicit about what your alternative is. Instead of the risk-free investment, I'm going to put in the 500 largest market cap stocks in the US. So you ready? As I go down this list, I'm going to list out what expected return you would need on the S&P 500 for you to switch. And you tell me. There's no right answer. There's one wrong answer that I hope nobody picks. But outside of that, everything is fair game. So you ready? Right now, you're earning 3% guaranteed. I'm offering you the Vanguard 500 index fund. And I'm asking you what expected return you would need to switch. Less than 3%. Okay, this is the one answer that you shouldn't take. And you can see why, right? If you're making 3% guaranteed, you'd have to be out of your mind to take your money out of something 3% guaranteed and settle for 2% on a risky basis. So thank God for small blessings. Because a lot of you had put up your hands and said, you know what, you're beyond redemption. Might as well give up on this class right now and go back to corporate strategy. Okay? Let's keep going. Okay? So cross out that so you're very clear that less than 3% is not an option. How about 3 to 5? Anybody here 3 to 5? Okay, 2 people. Least risk-averse people in the room or most risk-averse people in the room? Least risk-averse people in the room. You know what the consequences are going to be? You're going to be quicker into stocks than everybody else. You're going to have more risk in your portfolio. There's nothing right or wrong about it. That's the effect of risk aversion. Least risk-averse. 5 to 7. So that's a risk premium between 2 and 4%, right? 7 to 9. It's like the middle of the distribution. 9 to 11. More than 11%. Nobody? Really? Oh, 1. Okay, more than 11. Most risk-averse guy in the room. Again, nothing wrong with that. One thing though, if you're getting married, try to match up risk aversion before you get married. Right? The most risk-averse person marries the least risk-averse. I don't even want to see what happens to your portfolios, right? Okay. But think about where those differences in risk aversion came from. In fact, this is one of the most studied concepts in economics, what drives risk aversion. So I'm going to throw some broad choices at you. And you tell me which groups are going to be more risk averse. Older people versus younger people. Who's more risk averse? Older people tend to be more risk averse. What does that mean? In fact, there are consequences. If risk premiums rise as people age, I would expect risk premiums in Japan to be much higher than risk premiums in the rest of Asia. Why? Because Japan has the oldest population in Asia. There are consequences. Europe and Japan have a problem with aging populations, and if nothing else, holding all else constant, that's going to mean risk premiums will go up. And what will happen to stock prices if risk premiums go up? If you want to earn a higher risk premium, what's the only way to do it? Is by paying less for stocks. So age matters. Now this is a touchier issue. Men versus women, who's more risk averse? It's actually tricky because young women are more risk averse than young men. Something I can attest to because I have 4 kids and one of them is female and the other 3. And there's only one kid whose car I will get into when that person is driving. And it's not my son's. Those kids are crazy. A 22-year-old male is the worst possible risk taker, right? So young women are more risk averse than young men, but as you age, it catches up. So 40-year-olds, you're roughly the same, with one exception. Men still remain less risk averse on small bets. So that Super Bowl bet you made for $50, you didn't even think about it, right? I mean, my son made a $500 bet in the Super Bowl. Didn't even faze him. My daughter, for a $5 bet, would be weighing the odds. No, I don't think this will work for me. No? So risk aversion does vary across the sexes, but not by much as you age. But a lot of risk aversion you're born with. There's nothing you can do about it. And with my 4 kids, I can tell you which ones are going to be invested in bonds for the rest of their lives and which one's going to be the option trader. My oldest, who's 27, still walks down the stairs holding onto the banister. I might fall now. This is a fixed income guy if you ever saw it, right? You need assistance at every step. You're terrified. Okay, I know that's exactly what his portfolio will look like. My youngest, when he was 2, took off from the top stair expecting to be caught before he hit the bottom. As an option trader, something good's going to happen. Why should I think about it, right? The reality is we're hardwired already. I can't make you more or less risk averse. And that's what's driving this choice of premium. That's why I said there's no right answer. There's one wrong answer, but there are no right answers, because this is something that's in you. So if this were the entire market, here's how I'd compute the equity risk premium for the market. Each of you gave me an equity risk premium, right? So when you picked 5 to 7, you said your premium is between 4 and 6, or 2 and 4%. 7 to 9, 4 and 6%. I would go around the room, collect each of the premiums you gave, and take a weighted average. Saying weighted by what? Not by how much enthusiasm you showed when you put up your hand, but weighted by how much money you have. Let me be brutally honest with you. If you have no money, I don't care what your equity risk premium is. You can whisper it to me, you can scream it at me, I don't care. You have a lot of money, I care a lot. That's why what Warren Buffett thinks about the equity risk premium right now matters more than what everybody in this room, this building, perhaps the entire neighborhood thinks about the risk premium, because that's why $45 billion brings to the table. This is a weighted average number. It's not a democracy, it's a dollar-weighted democracy. And if you think about the equity risk premium in the market, that's what's driving that number as a weighted average. Now you can see the challenge. Our job is to estimate what this weighted average number is, and here's what's going to make it even more challenging. Remember that test I ran on you where you had money invested at 3% guaranteed, and I offered you a choice of investing in the S&P 500? Let's assume that while you were sitting here in the first 30 minutes of trading today, nothing's happened, no, first hour and a half of trading at least, nothing happened, so don't freak out. The market dropped 20%. Just a little fact I'm throwing into the mix. Same question I asked you just a minute ago. You have your money invested guaranteed at 3%. Would you invest in stocks? I've just thrown this fact that just in the last 15 or 20 or 25 minutes, markets dropped by 20%. Do you think that might alter what you demand as a risk premium? Let me go down the choices again. You tell me which of these you would do. How many of you demand a larger premium now? Come on, be honest. You just saw the Dow drop 3,000 points. You still feel the same thing about stocks you did? So let's face it, a lot of people, when they see something catastrophic happen, it changes the way they think about risk. So how many demand a smaller premium? And the rationale would be?
More likelihood that it rises.
In other words, if you're a true contrarian investor, it's better to buy stocks when they're at 16,000 rather than 20,000. I'll also tell you, it's much easier to say this in the abstract than to actually do it. One of the most difficult things to do in investing is in the midst of a sell-off, reach to try to buy something. It's like a hand is frozen. Can't go there. No, can't do it. But if you can pull it up, so you can see that for some people risk premiums will go up, for some people risk premiums will come down, and for some people it might not be affected. You're saying, so what? Remember I said the market premium is a weighted average of what people demand? That's a shifting number across time. So even if I said I can pull this off, I can take a weighted average premium for the entire, I can send an email out to every investor in the US equity market, and they all respond back with a number. 3%, 5%. It's not going to be enough because that number is a shifting number. So not only are we trying to estimate this weighted average across millions of investors, but it's a shifting number that changes every minute of every day. So let me set up the process by which we try to estimate this premium in corporate finance. There are 3 broad ways in which you can try to estimate the premium. One is to do something very similar to what I did with you. How much would you demand as a return? See, what do you think stocks will do over the next year? A survey premium, where you ask people what they would demand as a premium. The second is to look backwards. You know what I mean by looking backwards? I can tell you what stocks have done relative to risk-free investments over the last 50, 60, 80 years. Maybe your assumption is that's what I will make in the future. The third is to try to come up with a premium that reflects where markets are today. A forward-looking premium. So I'm going to take you through each of these and talk a little bit about the pluses and minuses, okay, and explain why I'll end up with the choice that I do. So the first choice is to ask people what they would demand as a premium. And usually the form these surveys take is they ask investors, what will stocks do over the next year? So how is it going to give me a risk premium? If you tell me stocks are going to be up 8% over the next year, What's your risk premium? 8 minus 2.5 is 5.5%, right? The problem is I can't ask every investor. There are too many of them. So almost all of these surveys pick a subset of people to ask. So Securities Industries Association used to ask individual investors that they picked at random. What do you think stocks will do over the next year? They stopped doing this in 2004 because they found it was completely useless. Because what they were getting were not expectations, but hopes. You know what I mean by hopes? What do you think stocks will do? I want them to make at least 12%, so I'm going to say 12%. There's nothing, anybody can say any number they want. Merrill Lynch actually does a survey of just big institutional investors. You're saying, why is that important? Because remember, it's a weighted average. So if you're managing $100 billion of money, I care about your views more than somebody who has 100,000 to invest. The premium they were reporting in 2013, I think our 2014 update was about 5%, 4.8 to 5%. Campbell Harvey and Graham, who are professors at Duke, do a survey of CFOs. It's a very different sample, right? Because in portfolio managers saying this is what I expect stocks to make, CFOs are talking about the premiums that they use within companies to come up with hurdle rates. And the CFO premium was about 4.5% in 2012. That gets updated. It's now 4.6%. So CFO. Pablo Fernandez, who teaches at Spanish Business School, does a bunch of surveys every year. He surveys equity research analysts, saying, what are you using as your equity risk premiums when you do valuations? And that number was about 5% in 2011. One of the most useless surveys of all, he surveys academics. You see why it's useless? If an equity risk premium is a weighted average, why bother asking academics who don't have much weight in this process anyway? But his question is, what do you teach in classrooms? Because maybe you leave an imprint, good or bad. And so you can see the premiums are all over the place. But the problem with all of these premiums is they're usually reflective of the past. And here's what I mean. If stocks have done really well for the last 10 years, people's premiums seem to go up. If they've done badly, they come down. And I have a very simple reason for ignoring their survey premiums. I mean, and I'll back this up. When I want to know the premium, I'm going to watch what you pay, not what you say. Because it's easy to say whatever you want. I want an 8% premium, 10%. That didn't cost me anything. 12, 15, 18. I can make up whatever number I want. I don't know of a single investment bank or consulting firm that actually uses survey premiums as their equity risk premium, including Merrill, which does the survey premium. They don't use it internally. So why do they do it? It looks like a nice, precise number that they can throw out every month. This is what the premium is. There is one segment which does use survey premiums, but even there the practice is dropping off, which is real estate. In real estate, there's this outfit called Cushman & Wakefield, which actually every quarter used to report this. They used to put out an 8-page brochure where they'd report what real estate developers were demanding as returns by region of the country and by type of property. So let's assume you're planning on investing in commercial property in Florida. You could go to Florida, look across commercial property and say 9.1%. That's what developers were demanding as a return. It's a survey number. The reason it used to work is it was a small, compact market. There weren't that many developers, and they all basically fed off each other. But even there, the practice is breaking down because of the entry of REITs and master limited partnerships that don't want to use those survey numbers. So the bottom line is, there are lots of surveys you will see out there. Most of them will put out a number. Very few people end up using it because it doesn't seem to be a good expectation for the future. Which brings me to the approach that most people use in practice to get an equity risk premium. This is how I was taught to estimate equity risk premiums, which is to look backwards. I think last session you mentioned how, were you the one who mentioned how backward looking we were on estimates? This is a backward looking estimate. So when I ask you what the equity risk premium is for the US, you compute a historical premium. You're saying, what does that even mean? You take the last 50 years. You look at what you'd have made on average investing in stocks. Let's say it was 9%. You look at the last 50 years, you see on average what you'd have made investing in T-bonds. Let's say it's 4%. 9 minus 4 is 5%. So that's my historical premium. And then you make a leap of faith. Leap of faith in what sense? Is that if that's what I've earned over the last 50 years, that is what I can expect to make in the future. You're falling back on what is perhaps the most widely used practice in investing, which is called mean reversion. And mean reversion is you assume things always revert back to the way they used to be. me ask you a question. When does mean reversion work and when does it fail? What has to be true about a system for mean reversion to work? Yes, go ahead. It's a stable system, right? So if you have a stable system, mean reversion works because even though you have swings, you revert back to the mean. You would do this in everything, right? Baseball, if I took a lifetime 250 hitter, and he's hitting 400 after the first week of the season, and I ask you, what will he hit at the end of the season? You'd be crazy to say he's going to hit 400. What do? You assume he will revert back to his mean. And we do this all the time. The only problem is, if you have a 41-year-old hitter who's hitting 220 and he's a lifetime 300 hitter, you might be a little more cautious about assuming he's going to revert back to the mean because this is no longer a stable system. It's a system where there's been an age break or a structural break. See, who cares about all this stuff? For a long time in the US, historical risk premiums worked reasonably well. Why? Because the US was the most stable market of the 20th century. So basically you could essentially see things revert back to the mean. So if you used a historical average, you were on pretty solid ground. You say, what can change? We're in a stable system. We're in a developed market. In my view, 2008 was a break in the system. It was not just a crisis, it was a structural break. But there are people who still use historical premiums, and when they use historical premiums, they're assuming things are going to go back to the way they were in 96 or 86 or 76. I think it's a pipe dream, but it makes people feel comfortable. That's what we used to make. That's what we will continue to make. It's easy enough to compute a historical premium. At the start of every year, I do this on my website. So I'll show you what the numbers look like at the start of 2017. So all I do is I take stock returns going back to 1928, T-bond returns and T-bill returns going back to 1928. And I compute the average, and I compare the averages. The historical equity risk premium is the difference between what you make on stocks and what you make on something risk-free. The historical equity risk premium in the US is some number between 2.5% or 2.3%, about 8%. You say, how can that be? Because it depends on three choices I make. How far back in history I go. If I go back all the way to 1928 and I compare to T-bills, my risk premium is 7.96%, close to 8%. If I go back only 10 years and compare to T-bonds, I get a much smaller premium. So it depends on the slice of history I look at. It depends on what I define as risk-free. If I look at T-bills, I get a much bigger premium than T-bonds because the term structure is upward sloping in the US. T-bond rates are usually higher than T-bill rates. And finally, it depends on how I compute my average. This sounds like Stat 101, but there are two ways you can compute an average. You can take 80 years of stock returns, add them up and divide by 80. That's an arithmetic average. Or you can look at the compounded return, because money earns money, which is a geometric average. I get 12 different premiums. This is extremely convenient if you're an analyst, because you can basically use any premium you want. It's somewhere in that table. There are expert witnesses who make a living out of justifying any premium use because it's a historical premium. Technically, you're not lying. It is a historical premium. But we're forgetting Stat 101 when we treat all these numbers as equally reliable. In statistics, if I gave you 80 numbers and you compute an average, if this were a stat class, what are you required to put in brackets below the average? A standard error, to tell the world how uncertain you are about the number, right? It's a practice we very conveniently forget after we leave statistics. Because can you imagine valuing a company and putting a standard error in your valuation below it? Nobody would ever pay you to do a valuation. But the reality is each of these is an estimate. It's a statistical number. There's a standard error. I think, so what? If I told you the historical risk premium for the US is 4.62%, that sounds incredibly precise, second decimal point, until I tell you the standard error in that number is 2.28%. So think about it. The risk premium in the US, if I go back to 1928, is 4.6%. The standard error in that number is about 2.3%. If you remember your statistics and think about the range on this number, plus or minus 2 standard errors, your true risk premium can be anywhere from 0% to 9.2%. Fat lot of good that does you. And that's with 88 years of history. If I go back 10 years, let's see what we get. His risk premium is 2.3%. Think this is good, I can use a really small premium. The standard error in that number is 8.7%. I've told you absolutely nothing. You'd be amazed at how many valuations I see, especially in emerging markets, where people use 10 or 15 years of historical numbers to come up with the risk premium. It's almost like you completely forget your statistics because you're doing finance. 10 to 15, 20, 25, even 50 years of data is noise in this process because stocks are so incredibly volatile. I don't like using historical premiums anymore because of the structural break, but if you choose to use historical premiums, at least follow the following rules. First, be consistent about your risk-free rate. When I talked about risk-free rates, I said I was never going to use a short-term rate, that I was going to use a T-bond rate. So when I talk about premiums, the premium that matters to me is the premium over the T-bond. Second, use geometric averages. Why? Because they reflect reality. And here's a very simple example of why they reflect reality. Let's suppose you invest $100 in a stock this year. It doubles next year to 200, then drops back to 100 in year 2. So it started at 100, ended at 100. How much money do you make on this stock? 0, right? Through the magic of arithmetic averaging, I can convince you made a 25% return. You see why? 100 to 200 is a 100% return. 200 back to 100 is a minus 50% return. 100 minus 50 is 50 divided by... Don't let your actual portfolio fool you. You actually made a 25% return, even though it looks like you made nothing. That's what arithmetic averages do, is because they add up numbers across time, they give you a very misleading view of what you're actually making. So stick with T-bonds, use a geometric average, and go back as far as you can. Why? Because of the standard error problem. I have to go back to 1928, and even with 1928 error, which is a lot of data, I'm going to run into issues in terms of how much noise there is in the estimate. Now let's stay on this route, right? So let's say you decide historical risk premium is what you're comfortable with, and you decide, okay, I'm going to use this for the US. Okay, use it for the US, you have enough data, you can go back to 1926 or 1928. And in fact, I think it's Robert Shiller has a data set that goes back to 1871, if you want to. A lot of data in the US. But let's face it, you're going to have to estimate equity risk premiums for Russia and Indonesia and Brazil and China. And there you're not going to get the luxury of going back to 1871 or 1928 or even 1965. You might be able to go back only to 1991. So outside the US, you can give up on historical risk premiums. They're just not going to be enough data for you to come up with a reliable estimate. But this is a challenge, right? If I ask you to value Vale and they get 30% of their revenues in Brazil and ask you what's the equity risk premium for Brazil, and you say come back in about 65 years, I'll have enough historical data to do this, this is not a recipe for getting work done. So I'm going to embark on a path of trying to estimate equity risk premiums for other markets. And hang in there because it's going to get a little messy along the way. I'm going to start off with the presumption that I can estimate the equity risk premium for the US, maybe using that historical data. Let's say it's 4.62%. To get the equity risk premium in another market, I'm going to go through an intuitive exercise. And here's the exercise. If a market is riskier, I would expect the equity risk premium in that market to be higher than the US. If I define the US as a mature market and saying this is what I can make in a mature market, any market that's riskier than the US should have a higher risk premium, right? That's the easy part of the intuition. The tough part is how much higher. So I need a measure of how much risk there is in a country. And here I'm going to cheat. I'm going to use a measure I've already used. Where? When I came up with risk-free rates by currency, what did I do? I looked at your sovereign rating and I came up with a default spread, right? You're saying, but that's for bonds. I'm going to cheat and act like that is the additional premium I'm going to demand in that market because it's a riskier market. So let me take you back to November of 2013 so you can see how these numbers would have played out then. The historic risk premium then was 4.2%. That's a number that's risen to 4.62% now. It's 4.2% then. The default spreads I estimated for India, China, and Brazil, if you remember, based on their ratings, were 2.25% for India, 0.8% for China, and 2% for Brazil. That's it. I'm going to take that number and add it to the 4.2%. I'm going to dust my hands off and say those are the equity risk premiums for other markets and leave it at that. If you don't like using the ratings and then you want to use a sovereign CDS spread, that's fine. I can go with that as well. Just remember, you should have been taking that out of your government bond rate so that's what I meant about being consistent. When you do your risk-free rate in a currency, pick whatever default spread you want to use, because that default spread is going to ride all the way through your analysis. So this is the first way of getting risk premiums for other markets, is to take a US premium that you get out of historical data, wherever you make up, and then you, on top of that, add the default spread for the country. This is how 80% of banks get equity risk premiums for other countries too. They have a US premium plus a default spread. The problem with this is we are taking a spread we would demand for buying government bonds issued by that country and saying that is the additional amount I would charge for buying equities issued by the country. So here's my second intuitive question. If I'm demanding a 2.25% default spread for buying Indian government bonds, would I demand a larger premium for buying Indian equities or a smaller premium? Why? Because equities are riskier than bonds, right? You're saying that's easily said, but how are you going to come up with how much riskier? So about 15 or 20 years ago, I concocted a way of doing this. Okay? Notice again, I used the word concocted and said derived and said deeply thought out, no, concocted. Because I wanted a measure of how much riskier equity is than bonds, and to do that, I looked up the standard deviation of the equity index in that country. So in the case of India, it'll be the Sensex. In the case of Brazil, it'll be the Bovespa. In the case of China, it might be the Hang Seng or the Shenzhen. So basically, I look up the standard deviation of the equity index. Then I look up the standard deviation in the government bond for that country. See what I'm doing? I'm trying to set up an algebra problem. For instance, if the standard deviation for the Brazilian government bond is 14%. So this is how much variance there is in the bond. And the standard deviation of the Bovespa is 21%. It looks like Brazilian equities are about 1.5 times more risky than Brazilian bonds. And if I'm demanding a 2% default spread for buying the bond, I should be demanding a 3% spread. That's why I call it an algebra problem. I'm just scaling up the default spread for the additional risk of equity. So it's kind of a mild variant of what investment banks do. I'm just scaling up the spread for this additional risk of equity. So for India, I get 7.8%. For China, I get 5.64%. And that's the basis for my getting an equity risk premium for an emerging market. So I start with the US premium, and I'm still a little shaky on that number because it comes from history. But then on top of that, I add either just the default spread and stop there, or I take the default spread and adjust for the higher risk of equities. Yes? I think right now it's all over the place. So they won't even call it the US, they'll have a base premium. And usually the base premium comes from US data. You know why? Because every corporate finance and valuation textbook they probably see in class was written for the US, has the historical data for the US. It's a strange way to base your entire analysis. But many of them call it a mature market base on which they build it. But that mature market base is usually a US base. Yes? Take it a step at a time, you know. Yeah.
Equity risk and bond risks are highly correlated. This highly correlated, that means like almost one. So the role.
No, it's not with country risk. If, equity risk and bond risk is highly correlated if the only reason for bond risk is changes in interest rates. But if you think about a country like Brazil, what causes interest? So when we talk about the government bond in Brazil, it's not just the interest rate that's changing, but every time political risk in Brazil. So for instance, the last 2 years, that spread widened. This has nothing to do with interest rates. It's got to do with political risk. So when you start talking about emerging market bonds, you're talking about country risk and interest rates, both driving that process. And you're trying to bring that into your equity risk premium.
Yes. If that's the case, why not bring in the coefficient, like correlation coefficient into the formula?
No, because you're not talking about combining the two in a portfolio. You're just saying one is risky, this is, so I'm thinking of it more in terms of a relative risk measure. If you have an investment twice as volatile as mine, I should demand twice the risk premium. Because if I bring in any kind of covariance and correlation, I'm sunk. Because then we have all kinds of covariances to worry about. So think of this on a much simpler level. I know what the spread is for a bond, and this is how risky a bond is. I know how risky equity is. Let's think about how much more of a premium I would demand for investing in equities. So that's the process by which I get the risk premium. But as you can see, it builds off that historical risk premium. And I've already dumped on it, right? I don't like historical risk premiums. They're backward looking. They don't reflect the fact that the world we're in is very different than the world they come from. I'd really like a forward looking premium. So how the hell? So when I first suggested this 20 years ago, people said, you can't do that. I said, why not? We do this in the bond market all the time, right? In fact, to see how we do this in the bond market, think of how you compute the yield to maturity on a bond. Somebody help me out. How do I get the yield to maturity on a bond? Come on, foundations. Do I have to bring Bill Silber in and kind of do... Alex, you want to help me? Since I know your name, now you're in trouble. How do you get the yield to... Don't look at your notes. It's not going to be there, right? Yield to maturity in a bond, I'll help you out. So you have a bond with a 4% coupon rate and a $1,000 face value. So how do I compute the yield to maturity?
You take the rate and multiply it. You raise it to T minus or T plus, whatever.
You do. I mean, those are the mechanics. But what are you solving for with yield to maturity? It's that discount rate that makes the present value of the cash flows on the bond equal to the price of the bond. Not the face value, because the face value will give you 4%. It's whatever the price of the bond is, what discount? It's an IRR for a bond, right? That's what a yield to maturity is. So with the bond, if you can tell me the bond price, the coupons, and the face value, I can tell you the yield to maturity. It's a forward-looking number, right? Because I'm basing it on future cash flows and what you're paying today. I stole that idea and applied it to stocks. So here's what I'm going to do. I'm going to take the S&P 500 on, in this case, November 1st of 2013, because that's when I was doing this analysis. On November 1st of 2013, the S&P 500 was at 1,756.54. So instead of buying a bond, what have you just bought? The 500 largest market cap stocks in the US, right? Instead of a coupon, what do you hope and pray you will get as cash flows? Dividends, and in the case of US stocks, increasingly the second way they return cash is with buybacks. I don't know what they will be for the next 5 years, but I can tell you what they were in the 12 months leading into November 1st of 2013, and that cash flow would have been 82.35. Hang in there. You bought the 500 largest market cap stocks. I know what the cash flow was last year. I'd like to estimate what the cash flows will be in the future, but rather than put my numbers in, I'm going to look at what the market is expecting those cash flows to grow by. The S&P 500 is the most tracked and followed index in the world. What do I mean by that? There are actually a dozen analysts whose job it is to look at the S&P 500 collectively and forecast out earnings for the S&P 500. Are they always right? No, I don't care. And whether they're right or not is almost irrelevant, because you want market expectations. And November 1st of 2013, they were expecting a growth rate of 5.59% a year for the next 5 years. So let's bring it all together. I have my cash flow of 82.35. I'm going to let it grow at 5.59% to get my expected cash flows for the next 5 years. Do you see what I'm trying to construct? I'm trying to make this look like a bond. I have the price of the index. I now have expected cash flows. I have one final problem. With the bond, there's a maturity date and everything comes to a nice close. With stocks, these cash flows can continue beyond year 5, essentially forever. And I can't forecast cash flows forever. But remember, these are the 500 largest market cap companies in the US, right? At some point in time, their growth rate has to converge on the growth rate of the economy, because they can't keep growing faster than the economy. So if only I could estimate what the growth rate of the economy was going to be after 5 years, I'd be home free. What did I say the risk-free rate was driven by? Expected inflation and expected growth in the GDP, right? You see where I'm going to go next? I'm not going to ask some economist what the growth rate is. They don't even know what the growth rate was last quarter. Forget about the next 5 years from now. Why do I want to waste my money? So I'm going to use the T-bond rate as my proxy for what the growth rate is. And the T-bond rate on that day was 2.55%. So beyond year 5, I'm going to assume the cash flows continue, and they continue growing at 2.55% a year. So let me bring this all together. Instead of buying a bond, you bought the S&P 500. Instead of getting coupons for the next 10 years, you're now getting cash flows for the next 5 years, and those cash flows grow forever. I'm going to ask exactly the same question about stocks that I did with the bond. What discount rate will make the present value of my cash flows equal to what I paid? It's an internal rate of return. It's a little messy because you got all these numbers in the 1 plus R, 1 plus R squared. I used to solve a function in Excel. extraordinarily convenient. It comes back and says 8.04%. You say, what does it even mean? If you bought stocks on November 1st of 2013, I don't care what you hoped you would make, what you prayed you would make, what you thought you would make. Given what you paid for those stocks, you can expect to make 8.04%. I'm almost home. If that's what you expect to make on stocks, and the risk-free rate is 2.55%, the difference between those two numbers is going to be my equity risk premium. On November 1st of 2013. Could it be different on November 2nd? Of all the numbers I'm using, which one's going to be the most volatile on a day-to-day basis? Risk-free rates change, cash flows could change, but the S&P 500 could go up 10%, drop 10%. Every time the market moves, I feel it. I feel it and I adjust. So if the market drops by 10%, remember, if your bond price drops, interest rates go up, same thing applies here. Stocks drop, your equity risk, that to me is the definition of a crisis, is basically the price of risk changing dramatically on a day-to-day basis. Yes?
Your current forecast of infinity, why do you use 10-year risk-free as opposed to something longer?
You know what? You could use a 30-year, but then from that point on, whenever you do cost of capital, you have to stick with 30-year. So basically, you can use a 30-year bond. There's no wrong. Your premium will get smaller, your risk-free rate will get higher, but then do everything off the 30-year rate. Right? So in fact, all that will change then is when you do the risk-free rate, make it the 30-year bond rate, which will be like 3.04% that day, and the whole process will go through. The 8.04% won't change at all. It's the risk-free rate that will change. The risk premium will get smaller and the risk-free rate will get bigger. Yes?
So the stable dividend payout rate 5.6% was based on the past years.
Yeah. Basically, because it's the S&P 500, I'm not trying to do any tricky stuff because strange things can happen if I try to get too clever. Right? Yes? It doesn't matter. Once you get into steady state, 2.55%, it doesn't matter if you stop there or keep going. You'll get the same value as your IRR. If I pull this out to 10 years, as long as my growth rate is 2.55% between years 6 and 10. If you let the high growth continue for 10 years, then you get a different number, right? And the reason I don't want to go past 5 is the expected growth that I need as an input, the most I can get it for is 5 years. And even that is stretching. So that's why I stop after 5. So let me pull this all together because this is kind of a tangent I've taken you off. Remember that base premium that I need for the US that I showed you, the historical premium? Now I have two comparators here. I can go with the historical premium, which in November of 2013 would have given me 4.2%, or I can go with the implied premium, which is about 5.5%. So that's my choice. Do I want to go with this backward-looking number that assumes mean reversion, or do I want to go with this number where I've made all these estimates, but is at least forward-looking? And to me, this choice has become a no-brainer. I would rather take a forward-looking number where I have to make estimates and could be wrong than go with this backward-looking number where I'm assuming things are going to go back to the way they were in 95 or 85 or 75, because I don't think that's going to happen. So from this point on, you're never going to see the 4.2% again. You're going to see my base premium for the US become 5.5%. And if you give me any other market, I'm going to take the 5.5% as my base for the US and adjust for whatever the risk premium for that market is, using the default spread and the risk of equities. Okay? So here's my process then for coming up with the risk premium for other markets. Yes?
How much variance have you seen in the historical and forward-looking premium? I understand November when
It's huge, and it often moves in the wrong directions. And here's how. Let's take 2008. Horrible year for stocks, right? When I compute the historical risk premium at the end of 2008, what's going to happen to the historical premium when I add on 2008? Because I'm bringing in a really bad year for stocks, my risk premium is going to go down. Think about what I'm telling you. Midst of the worst crisis in history, I'm coming to say you should demand a lesser risk premium for stocks. What person in his right brain would have said, no, December 31st, whereas the implied premium pushes in the other direction? The variance between the two numbers has widened over the last decade. Implied premiums now used to be lower than the historical premium pre-2000. Now they're higher than the historical premium. And I think it reflects a shift in the world towards the fact that we're now a global marketplace, whether we like it or not. Everybody's problem is everybody else's problem. Shanghai sneezes, Sao Paulo drops, right? That's the nature of the market we're in, and that's what we're capturing in these shifting numbers day to day. Yes, go ahead.
But back in 2008, it would have been very difficult to predict those cash flows.
Yeah. I would see if you ask me, would this have let me predict the crisis that was coming? No. At that point in time, those were my best estimates. That's all you can do, right? So will there be a crisis in 2017? I have no idea. And I'm not going to put myself in the position of forecasting the next crisis and trying to bring it in, because that's hubris. I mean, it never works, at least for me. So here's the process by which I'm going to get equity risk premiums for other countries. I'll do it in November of 2013, then I'll show you the updated number from 2017. I'm going to start with the US implied premium, and I'm going to call it my mature market premium. You think, why because here's my rationale. Let's say we have the US, Germany, and say we take US, Germany, and Japan and call them mature markets. Now, let's for the moment call them. If they were all mature markets, I'm going to argue that their risk premium in these markets has to be the same. Why is that? If they're all mature markets, the premium in Germany is 7, the premium in the US is 5, the premium in Japan is 3. What's going to happen? They're all mature markets. You as investors can decide, not even arbitrage, the money will leave the Japanese market because why will I settle for a 3% mark? So if you have mature markets, almost by definition, their premiums can't be that different. So this isn't a parochial rationale for using the S&P 500. I'm going to use the S&P 500 as my base premium for the US, and then I'm going to extrapolate that premium to every other mature market. And here I ran into a problem. How do I decide which markets are mature? I'm not going to sit there and say this market is mature, this one. This is asking for trouble. Because every market I label immature, I'm going to hear from. How dare you call us immature? So on this one, I punted. I went to Moody's. I looked up the sovereign rating. If your rating is AAA, I called you a mature market. You're saying, that is so lazy. Guilty as charged. So every AAA rated country, you're going to see the US risk premium. If you're not AAA rated, then my job begins, right? So if you're AA, single A, then I'm going to take your default spread and do what I did with Brazil and China and India and compute that additional risk premium. By the time I'm done, I'm going to have the US premium plus that additional premium. I'm going to have a picture that looks like this. November of 2013, this is what the world looked like to me. So let's start with the easy numbers. 5.5% for the US. How did I get that? That was my implied premium at the start of November of 2013. Why is Canada also 5.5%? Because it's AAA rated. In fact, Australia is AAA rated, Germany is AAA rated. So basically every AAA rated country you're going to see 5.5%. Any country that's not AAA rated, you're going to see 5.5% plus this red number is the additional risk premium based on the default spread times the risk of equity. So basically I end up with a risk premium for the world as I saw it in November of 2013. You're saying you're only 5 companies and 5 countries. Why the hell are you looking at the entire world? Do you know why I have to look at the world? I have 5 companies and 5 countries, but they have business in the rest of the world. And that's a point I want to emphasize. For too long, we've adopted this lazy practice of, if I know where you're incorporated, I know what your risk premium is. Not really. So let me take my companies and show how this process would work out, because here's the reason I want to do risk premiums by country. So if you take Disney. Disney is a US company, Burbank headquarters. It gets 82% of its revenues, at least in November of 2013, in the US. It gets 11.6% in Europe, 6% in Asia Pacific. I was amazed at how little it got from Latin America, 0.33%. To get an equity risk premium for Disney, here's what I did. I took the proportion of revenues Disney got from each part of the world, and I took a weighted average. You're saying, why weight by revenues? Why do you think I weighted by revenues? Actually, 2 reasons, and you probably can isolate each of them. Why not by EBITDA or EBIT or net income or total assets? Because beggars can't be choosers. Most companies will break revenues down regionally. Look for your company. This is why I wanted you to pick a company. Class today, look through your 10K because they'll give a regional breakdown. Almost every one of them will break down by revenues. Very few will break down by EBITDA or EBIT. And when they do break it down by EBITDA, EBIT, I wouldn't throw those numbers further than I can, whatever. I lost the analogy somewhere along the way. Because here's the reason I don't trust EBITDA and EBIT. Who estimates these EBITDA and EBIT numbers? Accountants. Magically, you're going to find that your Irish operations make a lot of money. Oh, amazing. Maybe it's got something to do with a 12.5% tax rate. So I stick with revenues because accountants can do the least damage to that number. But I'll be flexible. If I were doing Royal Dutch, where's the risk of an oil company come from? It doesn't come from where they sell the stuff. It comes from where they get the oil, right? So for Royal Dutch, the equity risk premium I computed, and this was last year, I took their reserves, which are in the most dangerous parts of the world, and I took a weighted average. So I'm not stuck on revenues. If you feel that for your company, they give you total assets by region, and you think that is a better measure of where the risk exposure comes from, go ahead and use it. Yes?
Scaled up risk premium?
These are the scaled up in what sense? Those are the...
In terms of the equity?
Yeah, these are the scaled up premiums because I prefer that scaled up approach. So any premiums you see from me will be those scaled up premiums. But if you see an investment banking equity risk premium for a country, it's often just the default spread. Right. So that's my equity risk premium for Disney. Remember those other companies? Here's what the risk premiums look like for the rest of my companies. Bookscape, I got lucky. That's the private bookstore in New York City. It's not like you have, lots of foreign tourists wandering into the store. So it's 100% US. That was my easy company. I looked at Vale. Brazilian company, right? Remember last session I said whenever you're in trouble and you don't know the answer to the question, just say China. Guess Vale. Its biggest market is China, 37% of its revenues. The equity risk premium I'm going to use for Vale is a weighted average. And that weight reflects where they do business. It's a global mining company that happens through the accident of history to be in Brazil. Tata Motors. In fact, last year, China became Tata Motors' biggest market. So in 2013, India and China were kind of competing. And that was Jaguar Land Rover that basically is getting them, again, risk premium across. Baidu, I don't think anybody outside China ever uses Baidu. So thank God for that because it means my estimate of the equity risk premium gets a lot simpler. It's basically the Chinese risk premium. And Deutsche, basically, I looked at their financial asset exposure and again, it's a global bank that happens to be German. That's a principle I want to come back to again and again. When you think about your companies, don't just think about where they're incorporated and traded. So if you thought you could escape from this country risk discussion, you were sitting there and said, thank God I picked a nice US company. You might want to revisit that comfort zone and actually take a look at a US company. Right? So in fact, this morning I was trying to value Snap. It's going to go on my blog probably tomorrow. And I was looking at where their users were. Surprisingly large number of people outside the US have the same impulse control that draws you to Snap, right? Because let's face it, that's what you need. If you take photos, you say, oh my God, what did I do? You want something that disappears in 15 seconds. It seems to be a global phenomenon. And so when I did the equity risk premium for Snap, I had to look at where the users were. Until about 2008, I used to estimate this implied equity risk premium for the US once every year, start of every year. And I'd use it through the entire year. And if you asked me to defend that practice, I'd have said, you know what, the US is a developed market, and the price of equity risk is not going to change dramatically over the course of a year. So why are you making such a big deal? In fact, in June of 2008, if you'd come to me and say, what's the equity risk premium for the US? I said, it's about 4.3%. And then I'd have said something that would have gotten me into a huge amount of trouble afterwards, but I wouldn't have known it then. I said, and it's not going to change very much for the rest of the year. It's almost like the gods are waiting for you to say stuff like this so they can whack you around the head. This is actually the implied equity risk premium for the S&P 500 on a daily basis, starting September 12th of 2008, ending December 31st of 2008. Saying, what's so special about September 12th of 2008? It was actually a Friday. And I was going home at 4 o'clock. Why was I going home at 4 o'clock? I keep academic hours. I come when I want, go when I want. So I basically wanted to go home. And as I was going home, I was checking out the news, and there's a news story that said Lehman was in a bit of trouble, but Barclays was putting together a deal to buy Lehman's. And I'll be quite honest. Friday at 4 o'clock, if you'd asked me, what do you think about this Lehman thing? I'd have said firm-specific risk. It's not going to affect the whole market. It's just one investment bank. It's going to be taken over by another investment bank. And I'd have been hopelessly wrong, because on September 15th, you woke up to the crisis. So every day I'd torture myself. As I came into work, I'd compute the implied equity risk premium that day. And guess what? The market was moving. So, I mean, this was a period the market would be up 1,000 points by 12:30 and be down 2,000 points by the end of the day. It was huge swings in the market. Not surprisingly, as you look at the equity risk premium, it starts the crisis at 4.3%. There was a day in November of 2008 where the equity risk premium for the US was 8%. And this is what made it such a scary. This was not supposed to happen in developed markets. This is Brazil. You say, oh, that's Brazil. Those Brazilians are so crazy. But this is happening in what you call the developed market. There was no safe place to be. And the lesson I learned from this period was never again would I estimate an implied equity risk premium January 1st of each year and use it for the rest of the year. Why? Because this can happen. So starting in September of 2008, I've been doing these estimates at the start of every month. So you'll see the February 1st, 2017 risk premium for the S&P 500 is 5.59%. Okay? In fact, if you look at the January 1st, 2017 number, so basically I did what I did in 2008, the start of 2017. The S&P is now up to 2238. The cash flows are now up to 108.67. And the implied premium I get using exactly the same approach I used then is 8.14%. What was it in 2013 when I did this, November 1st? It was like 8.04. It's now 8.14. The risk-free rate is down to 2.45% from 2.55%. The implied equity risk premium at the start of 2017 was 5.69%. If this were 2008, I'd use the 5.69% for the rest of the year, but it's not 2008. So on February 1st of 2017, I went and revisited this number, and it's now down to 5.59%. Incidentally, this number, November 1st of 2016, just before the election, was 6.26%. So it's dropped about 60 basis points, but much of that drop has come from what? It's come from risk-free rates rising. Risk-free rate was 1.8%. Because remember, it's a difference between what you get on stocks and the risk-free rate. But equity risk premiums now are about 60 basis points lower than they were at the start of November of 2016. And that's a reminder to me that I have to be careful. Every evaluation I do this month is going to start with this base. Yeah?
During 2008, do you think that the estimates for
the cash flows? That's always the weakest link here, right? Because the T-bond rate and the S&P 500 get updated every minute of every day. The cash flows, there's a lagged effect, because what happened was, as you went further and further into the crisis, companies started announcing stops to buybacks, cuts in dividends. So the cash flow effect took a while to show up. So initially, I was probably overstating the equity risk premium effect, but kind of caught up. By the time I got to December, it was caught up. But that's always an issue in crises, is how much of the cash flow effect are you missing because you're not updating it every day. In fact, last year, I've started doing this daily stuff every time there's a crisis. And guess what? There's a crisis every year, right? It's the China crisis 2 years ago. Then you got the... So each year you pick a crisis. Brexit last year, I did the FTSE every day around the Brexit. It's a great way of getting a sense of how scared are people, because you listen to stories, you're going to freak out. Because the stories are, oh, the premium should be higher. I don't care what the story tells. Let's look at the numbers and let's see if, in fact, investors are as scared as the experts are. Because ultimately, experts are not the ones driving the market. So you can tell me all the scary stories you want, but this number reflects what you're actually paying for that risk. Just to give you a sense of where we're standing right now at about 5.69 or 5.59%. This is U.S. implied premiums going back to 1960. So this tells you the story of U.S. stocks if you go all the way back to 1960. They're the 1960s. Incredibly stable period for U.S. stocks, right? Premiums between 3 and 3.5%. Nothing happens to it. Then you go to the 1970s, the premium shoots up. What's causing the equity risk premium in the US to jump in the 70s, you think? Oil was the precipitating factor, but what did oil cause that was so damaging to financial assets? It was inflation, high inflation, which inflation that US investors were not used to seeing. Equity risk premiums went up. Inflation is deadly for stocks. We don't realize it until it actually happens. That's why when you get these people saying, why don't we let inflation be 3% instead of 2%? I mean, they don't realize inflation, once it's out of the bottle, is like a genie. It just kind of takes over, right? Anybody from Latin America will tell you, inflation is not something you control once it's out of control. So basically, 1978, the implied equity risk premium in the US hit 6.5%. Fortune ran a cover article saying stocks are dead. And that should actually be an indicator for you. Whenever the Wall Street Journal, Forbes, and Fortune all tell you to get out of stocks, take everything you have and put it into stocks. Historical contraindicator. And of course, 1978 through 99 was one of the great bull markets of all time. You see why it's a bull market? The premium goes down, stocks are climbing. End of 99, the implied equity risk premium in the US was 2%. You know why that should scare you? When we did that survey, I think there were 2 people who said they would accept a premium between 0 and 2. If that were true and the market's delivering only 2%, what should the rest of us be doing? You should say stock. If you say the premium is too low, you're saying stocks are too high, right? You'd be selling your stocks. That was 99. That was the peak of the dot-com boom. And people told us there's been a paradigm shift, which basically means I have no idea what's going on. So let me call it a paradigm shift. And the paradigm shift happens not to be a paradigm shift, so the premium bounced back up to 4%. It stayed around 4% till 2008. And since 2008, notice how much more volatile the premium has become. Because every year there's some macro crisis rolling through the world, right? Whether it's the EU crisis, the Greek crisis, the Brazil crisis, the Brexit crisis. Get used to it, because this is the way the world is going to be. So the companies are saying, I'll wait for this crisis to end. For what to begin? The next crisis to begin? You have to live in this world of rolling crises, which means we have to get used to equity risk premiums being much more volatile. Which brings me to my updated page. Incidentally, if you want to get my US implied premium as of the most recent month, the easiest way to get it, if you go to my website, the very front page has it. It actually has the Excel spreadsheet. So if you want to tweak the numbers yourself, I'll send that spreadsheet out to you so you can download the spreadsheet and enter the numbers. If you're too lazy to do even that, I have a third solution. I have to thank my daughter for this. About in 2010, I'm staying at home. I decided to stay at home, not come into work that day. I would say in my office, but I don't have an office. I have a little corner of a room that's mine, so I'm sitting there minding my own business. When my daughter busts into the room, she never walks in, she never waltzes in, she busts into the room. She says, Dad, you have a Twitter account. I said, Kendra, I don't. She says, Dad, you're so old. Why you would state the obvious and walk out, I don't know. She walks out. I'm really pissed off. So I said, how difficult can it be to open a Twitter account? So open a Twitter account, I forget all about it. 6 months later, she busts into my corner of the room again and says, Dad, do you know you have 1,000 followers on Twitter? I said, what the hell are they following? I've never tweeted nothing. I go and sure enough, there are 1,000 people following somebody who never tweets. So I said, if they're following me, I have to give them something to follow. So my very first tweet, I think it was April 4th of 2010, guess what it said? The implied equity risk premium for the S&P 500 has just hit 5.33%. And start of every month, I tweet out the equity risk premium for the S&P 500. I don't have Kanye West numbers yet in terms of followers. Maybe I have to throw in some curse words that you blank out. No. But if you want to get the implied equity risk premium the minute I get it, so basically I'm looking for numbers now, because my revenge on my kids is going to be that I always have more Facebook friends than they do. I never post on Facebook. I definitely want to have more Twitter followers than they do. So I'm up to like 60,600, but that's not that impressive when you think about the fact that, as I said, Kanye West is like 40 million. And the guy doesn't tweet out the equity risk premium for any market, as far as I know. So if you want the implied premium for the US, it's there, right? So that becomes my base. And then I build the rest of the table. This is the most downloaded data set by far on my website. I've been doing this country risk premiums, and basically it has every country for which there's a rating. I've actually added a section which I didn't used to have for markets that I call frontier markets. These are markets which don't have a rating. Markets like Syria, Libya. I used to ignore them, saying, look, I don't have a rating. And then I got actually an email from a Syrian business person. There's actually one guy left in Syria who's actually running a business, saying, I need a hurdle rate, and you're not giving me an equity risk premium. I said, that's the thing you're worrying about the most? What are you, in a basement room with no bombs flying over you, you know? So, but I said, you know what? If you're a Syrian business person, you need a hurdle rate. That's the least I can do. So basically, this is the equity risk premium for the world as I see it, and I need it anytime I look at a company. One final point, you know, if you're from outside the US and your country is there and you don't like the number that I've attached to your country, don't be all pissed off and come up to, how dare you give me a 15% risk premium from Venezuela? Why is my risk premium 19.89%? The very fact that you're asking me that question suggests that you haven't been back to Venezuela for a while, right? But, I'll close with this. I get emails about these risk premiums all the time, and they come from the strangest places. One came from the New Zealand Milk Board. I didn't even know there was a milk board in New Zealand until I got this email saying, we're using your equity risk premiums to set milk prices for New Zealand farmers. Who are you selling the milk to? Zimbabwe? No. But usually I send this PDF file. My least favorite email of all time came from Libya in April of 2009. I'm sorry, Lebanon in April of 2009. And I'm excited. I don't get that many emails from the Middle East about valuation. I open it up, and here's how it begins. You have destroyed Lebanon. So what? How the hell did I do that? Now I can see myself destroying Luxembourg or Liechtenstein or one of these quasi-European principalities you can walk through in 15 minutes. How the hell did I destroy Lebanon? So I keep reading. It turned out that this email is from a business person in Lebanon who had his business appraised for value. And the appraiser had used the equity risk premium from my side to value Lebanon. That number is that was about 16% in 2009. He was really pissed off. You can see why, right? He uses 16% premium. You get a high discount rate, low value. It's all my fault. My initial reaction was not my fault. Take it up with the appraiser. But then I decided that discretion was a better part of valor here. So I said, it's not my fault. You see whose fault it is? Where do I get these additional premiums? I get the rating from Moody's. If you have a bad rating from Moody's, you're in the toilet. I can't bail you out. I said, it's not my fault. It's Moody's fault. And if you want an address to enter into your GPS, here's what it is. 75 Church Street, New York, New York. It's not 44 West 4th Street. Nothing untoward has happened yet. Okay? But none of this is my fault. I'm just a messenger here. No, ask me after class. Okay. I'll see you on next Wednesday. So if you can get a chance, if you get a chance, try to do the risk-free rate and your equity risk premium for your company, and please go into that Google shared spreadsheet and enter your company and the numbers as you get. So when you think about equity, you think about equities are like this company, like GE, stock, Microsoft. So whatever your net equity value is, goes down to this share count comes in only with the board decision. So they can fight, neither of them win at the board. Because the board, every director has the same weight. So if you own 5 shares and I own 5 million shares, it doesn't matter. In board meeting, we both weight the same. But let's say you piss me off a lot. What I'm going to do is I'm going to take my 5 million shares and I'm going to bring this up at the annual meeting. And because I already own 20% of the company, all I need to do is find 31% more to get my side.
Right.
Now, whereas you have a much... So, if you disagree at the board meeting, the fact that you own a lot of shares is irrelevant, but the fact that you have a lot of shares might mean that people are more likely to listen to you because they're afraid of what you will do if you're upset. If you go to the annual meeting. Because it's only the annual meeting that share count.
Okay. The interesting part of the discussion is more like, it seems like two people on the board of directors are trying to push someone out, and then they're trying to get...
The only way they can do that is through the meeting.